If you take all of those measures together and you take an average of those measures, it says that the market's never been as expensive as it is now. And that includes 2000 and 1929 and 2020, which are like record levels of overvaluation. So you've got an overvalued index. What's that mean? It means returns in the future are lower. It doesn't necessarily predict a crash, although when you have valuations like this, there has tended to be more market volatility and a reversion to the mean. And people say, well, there's a composition problem with that index, the value index. And those jaws will never close because the composition of those two indexes is so bad. I think that those jaws will close. And at some point, value will trade at a premium to growth. What the catalyst is the billion-dollar question. And I don't know what it is other than these things are always visible in hindsight and they're never visible ahead of time.
Toby, thank you very much for joining us today.
Oh, my pleasure. Love talking to you guys. Good seeing you again.
Good seeing you. Many of our listeners and viewers will most likely recognize you. You've joined us multiple times on Excess Returns, but for those who may not be as familiar, you're a longtime friend of the show. You're an author of multiple books, host of the Value After Hours podcast with your good friend Jake Taylor, and also portfolio manager behind 2 value-oriented ETFs. You can learn more about those funds. 2 different websites, acquirersfund.com and acquirersdeep.com. We'll put links to those in the show notes. We always love having you on because of your sort of insights just on the market. You kind of bring an honest and I think grounded approach to investing and value investing and sort of the history of the markets, which we appreciate. And I know our audience does too. We want to cover a couple different things today, sort of maybe start out with some market valuation charts and look at where we stand relative to history. And then, talk a little bit about value investing, struggles of value, what we're sort of thinking about value, and I guess how investors like us can try to stay mostly sane in a market that's, seems pretty expensive, but hasn't been expensive for a while. So
I'm also interested in learning how to do that. So anybody has any tips, let me know.
We were hoping you'd tell us.
These podcasts ended up being like a therapy session for all of us, but we get through it.
Just as a side, Justin, I believe Toby is still the most frequent guest on Excess Returns. I think this is appearance number 10.
Is it?
Wow, really?
I believe he still has the title of, some people have creeped up, but I think he's still number 1.
Thanks, fellas.
Well, and little inside baseball, and I've said this before on other podcasts, like the reason that Excess Returns exists is because of a conversation pretty much I had with Toby at a investing conference years ago when I was asking him about his podcast. And then, I came back and I think, Jack and I were thinking about doing it, but it kind of gave us sort of the boost to throw our hat in the ring. And here we are almost 5 years later with doing what we do. So thank you.
Yeah, you guys have got a great podcast. I follow it. I watch it late at night when it comes out on the TV because Jack makes such great thumbnails. Very clickable thumbnails.
The TV concerns me because I look better in like small. So it concerns me. Like more and more people are saying, I watch you on the TV, and I'm like, I don't want you watching on the TV. Like your phone is fine. It serves the purpose very well.
No, well, I think that's the statistic though. I think with YouTube, I think YouTube is being consumed now more on TVs than any other device.
That's. I mean, I watch more YouTube on TV than I watch anything else.
Yeah, it's crazy how it's kind of just, disrupting the whole cable streaming type thing. So anyways, okay. All right. So Tob, let's dive in. We wanted to start with you. Let's look at a couple of charts here. The first one is, and you put these, I think you shared these on Twitter or X or whatever we're calling it these days. The first one is the U.S. Market valuation with PE ratios relative to today to where they have been in history. And it kind of shows on a percentile basis, like how expensive things are. So I'll let you kind of sort of just talk to this and then we can kind of riff on it a little bit here.
So on this measure, on the measure of PE, all of the relative to their 20-year distribution. So it's only going back to 2005. So this is a chart from Goldman Sachs Global Investment Research using CompuStat FactSet data. on their metrics, they say the Nasdaq 100 is nosebleed expensive at 29 times. That's way at the top of its 20-year range, which you'd probably expect if you had a look at the index recently. It's right at the top of its 20-year range, all-time highs. Russell 2000, perhaps a little bit surprising at 24 times, a little bit north of its median over the last 20 years. S&P 500 at 23 times is off the end of its Richter scale at 23 times, but it seems to be saying that it's cheaper than the Russell 2000, which doesn't make a great deal of sense to me. The equal weight S&P 500 is at 17 times, which is also expensive, and the mid-cap index, which is the 400, is right at its 20-year median at 16 times. I don't know if there's much to draw from that chart. The PE, the single-year PE is flawed for a variety of reasons. One is that, you can have a bad year of earnings and then look at the PE, and PE is high when contrarian value fundamental guys know that often the best time to buy is when you have a trough in earnings, because even though the index PE might be the PE might be high, it's stretched on anemic earnings, and that's certainly the case for the Russell 2000. So I track large earnings as represented by the S&P 500, mid-cap earnings, S&P 400, and small-cap earnings represented by the S&P 600. The difference between the S&P 600 and the 2000 is they're slightly different parts of the 2000 is the smallest 2000 in the largest 3000. So the Russell 3000 is composed of the Russell 1000, which is the largest 1000, and the Russell 2000, which is the smallest 2000 in that 3000. The 600 is the 600 outside the Russell 1000. So it's like the largest 600 of the 2000. So they're not directly comparable. The index is also, it's junky. There's a record number of companies that have no earnings presently in that Russell 2000. So I would never advocate that somebody just go out and smash the buy button on the Russell 2000 because it's not a great index. But it is also true that smaller companies that are underfollowed tend to trade at better valuations than larger companies that are just not as many people following it. So you're much more likely to find undervalued small caps than you might find undervalued large caps, for example. And so if you look at the Russell 600, the S&P 600, the earnings are down considerably from their 2022 peak. And the 2000 also down very considerably from their 22 peak. So there's been this extended earnings recession in the Russell 2000, in the S&P 600, in the S&P 400, and in the S&P 490, which is the 500 excluding the 10 largest stocks, which are all of the ones that you can name off the top of your head. And all of the other ones that you can't name are the ones that have not performed. So aside from the beneficiaries of like the CapEx spending cycle, everything else is in an earnings recession, which is why all the other indexes are kind of crushed relative to the Mag 7 or the Mag 10 or whatever you want to call that very largest group of companies. So I don't think the single year PE is particularly interesting other than the S&P 400, which is the mid-cap index. I think the earnings trend for the 400 is basically flat since 22. Smalls are down, larges are up, but if you pass the large into the AI CapEx beneficiaries and the rest are sort of flat since 22. So there's been this sort of unacknowledged rolling recession since 22 in earnings for most stocks. And so the PE isn't a great measure. So I favor if you're looking at an index, I favor other multi-year measures. And so there are lots of examples of those sort of measures. The Shiller PE is one. So the Shiller PE is imperfect for lots of reasons, but one of the things that it does do is that it takes an inflation-adjusted average of 10 years of earnings as opposed to a single year of earnings. And the reason why that's significant is in 2008, the banks lost so much money that the entire index, the entire S&P 500 index's earnings were wiped out. And so you get an infinite PE in 2008 for the S&P 500 when in retrospect, that was one of the best years to buy that we've seen in the last, 25, probably more than that, 30 years. So the single year measure is imperfect for that reason. The Shiller PE is also imperfect because when you have rapidly growing earnings, which the 10 and the Mag 7 have rapidly growing earnings, it understates their earnings pretty significantly, pretty wildly. And so the Shiller PE may be overestimating where we are. Having said that, you can look at various other measures and just see, does the Shiller PE make sense in this context? So you could look at, for example, Tobin's Q looks at the replacement value of assets versus the market value of assets. When the market value of assets is way over the replacement value of assets, then you're better off listing, you want to get as much public equity out there as you possibly can because you get this gigantic uplift. You buy companies privately, flip them onto the public market, you get this big public arbitrage lift for no other reason other than the fact that this thing is public. And that index is also extremely stretched, about as stretched as it has ever been. Buffett's indicator, so Buffett likes to look at total market capitalization versus gross national product. Gross domestic product is everything that is made by companies that are everything that is made within the borders of the US. Gross national product is everything that is made by companies within the border that are resident within the borders of the US, but includes overseas earnings. It's a distinction it's a difference without a distinction because the two lines are identical. They give you exactly the same number, but it's never been as stretched. The market capitalization versus the earnings has never been as high as it is currently. So those measures are also off the charts. There's another measure, the Crestmont PE. I don't know exactly what makes up the Crestmont PE, but it's also extremely stretched. If anybody knows what that is, let me know, because I've looked it up a few times and I can't figure it out. It's on that dshort.com site.
Yeah.
And then just the market relative to its own trend is extremely stretched. If you take all of those measures together and you take an average of those measures, it says that the market's never been as expensive as it is now. And that includes 2000 and 1929, which are and 2020, which are like record levels of overvaluation. We may be in a new paradigm. So I had this guest on my podcast yesterday, and he believes that AI plus passive flows has created, we're basically trending towards this singularity where capital is no longer the limiting factor in business. We need a new paradigm. And the result of that is that we're going to have these extreme valuations, and that's just what we're going to have from here until kingdom come. I don't know if that's the case or not. I'm probably the other side of that. We probably do trend back to normal valuations over time. So the question then becomes what do you do? So you've got an overvalued index. What's that mean? It means returns in the future are lower. It doesn't necessarily predict a crash, although when you have valuations like this, there has tended to be more market volatility and a reversion to the mean in fairly short order. And we may be seeing the beginning of that today. But then what do you do with your capital is the natural question. And I think the answer to that is that there are other places that you can invest. There's value, there's international, there's small, and those are all pretty cheap on long run measures. And so the same thing happened in the late 1990s. Index got extremely expensive, was concentrated in a pocket of very large growthy companies. And they were very good businesses. They did do very well as businesses from 2000 to 2015, but their stock prices went sideways for 15 years because they had to work off the overvaluation. And I think the same thing happens now. Same thing happened in the Nifty 50 era. The 50 were, similarly to today, a totally bifurcated market where the 50 biggest were exceptional businesses, huge returns on invested capital, growing every year, generating lots of free cash flow, dominant moaty businesses. And they were the one, you just buy them and forget about them and never have to think about it again. We're in that same scenario now. In the Nifty 50 era, those businesses did continue to be very good businesses for 50 years afterwards. But the stock prices took a long time to catch up. And so that's people who are investors know this naturally, but people who are a little bit outside the market sometimes forget this, that a stock and a business are two things that are separate. Stock can get well ahead of the business, and it takes a long time to work off that overvaluation. So I think that's the scenario we're in now.
I think the other thing that this chart sort of points out is like, if you look at like the troughs, that's when investors got sort of great returns, a late 1940s, early 1950s, early 80s, 2000 and the financial crisis. It's like it doesn't mean that like future returns are going to be negative from here, but like the really strong returns in the market usually come at those troughs, coming out of a recession, coming out of a long-term decline. And, here we are with, as the chart shows, we're 3 standard deviations above the, average long-term historical valuation, which is pretty crazy.
The thing that I always like to, or that I have to hammer into my own head really, because I don't invest in the index, the main index, the S&P 500. I just sort of watch it from afar and I look at those valuations and I think they're egregious. But I would never use that to determine my own allocation to equities. It would just be where I direct my allocation to equities. And the reason for that is you can have a scenario like 2000 where the market was as expensive as it is now on, roughly on various measures, more expensive on various measures, cheaper slightly. And at the same time, you had massive value underperformance. Smalls underperformed, international underperformed. And if you'd said, well, I'll take this as my cue to get out of the market, then you missed all of that performance in small and value and international. And so I just say to folks, don't pull out of the market completely. Just redirect where your attention is to things that have, be a contrarian, look at the valuations. The valuation, I think, tells you what the forward returns are going to be. And the forward returns are pretty good to better than average in small, value, and international. And I wouldn't want to miss out on that because that was a legendary run in the early 2000s,
Yeah, we're all hoping we're going to have it again. It's funny, I was looking at this chart and my first takeaway was like, where is the .com boom on this NASDAQ 100 thing? Because I'm like, I'm sure the PE was much higher. Then I realized I'm so old that it's not in the last 20 years. So it wouldn't be in this chart. Like it's hard for me to believe that was more than 20 years ago, but I guess it was. I guess it's 25, 26 years ago now.
I looked at two other charts. I just shared these ones today. It looked at the equal weight S&P 500 versus the market capitalization weight. So the S&P 500 that everybody knows and loves is the market capitalization. It's actually float adjusted as well, which means that the companies with the largest market capitalization adjusted for float, so that excludes like insiders who own a big chunk, that part that they own isn't included in the public float. And the reason that you would do that is you could have some company with a very small public float that should be allocated a huge amount by an index fund, and they can't get it in because it's all almost entirely owned privately with only a small public float. So they make it float adjusted now. That S&P 500 is very, very expensive versus the equal weight version of it because it's so concentrated in the S&P 10 and not the other 490. And then I've also got, on the same chart, it shows the S&P 100 versus the 500. And both of those measures are extremely stretched, which just means that it's been a large growth market, whereas the equal weight is like a simple proxy for small value. So whichever way you measure it, it's been a market that since about 2015 on some measures, 2011 on other measures, 2006 on some measures, which is a crazy long period of time, that has favored large and growth over small and value. But it isn't always that way. It has been a mean reverting series over the 150 years of market data that we have, which means that it oscillates between large and growth and small and value. And we've had this extremely long run to large and growth that could easily reverse course and become a small value market for an equivalently long period of time. We could have a 10 or 15 year small and value market. I'd die of happiness if that happened, but and I'm not necessarily predicting it because it's hard after 15 years going the other way, but that's what it has happened historically. There's precedent is what I'm saying.
Do you think there's anything to this argument that this time is different? Like we'll put up this chart. You had this chart about we talked about earnings, but you have this chart of the S&P 500 excluding the top 10 earnings growth, and then just the top 10 on their own. And the top 10 on their own have massive earnings growth. And without the top 10, there's basically almost zero earnings growth there. And, there's these arguments. You talked about mean reversion, this idea that with the Facebooks of the world and these huge companies, you haven't seen the mean reversion you typically would see in margins and other things for companies of this size. I mean, do you think there's an argument? Like, how do we think about what breaks this? Like, can these companies, at some point they have to get so big, right, that they just can't sustain this. But it's just very interesting to see the dichotomy of them just keep going beyond what you thought was possible. And then the rest of, the economy just kind of, or the rest of the companies just sort of flatlining below them.
Yeah, man, you said it. The thing that really stands out to me is the margins of I've got another chart that shows the margins for large, margins for mid, margins for small. And the thing that really stands out is that on all three, the margins, even now, after like the earnings recession that we've seen since 22 in mid and small, the margins for mid and small are still above average. Going back to like 2000, like a 25-year period of time where margins have been pretty high for the most part. Even since 22, the margins are higher than they have ever been before. For the S&P 500, for the large, the earnings have never been higher. The margins have never been higher. Margins like 13%. And you can find quotes from Buffett, Hussman, Jeremy Siegel. Sorry, not Jeremy Siegel. Who's GMO? Grantham. Jeremy Grantham, where they all say margins are the most mean reverting series in finance, in capitalism, because anytime you see a big fat margin, you want to go and compete that. That's free money. You go and compete that money away if you can. And anytime you see margins running much over 6%, you're going to mean revert to 6% because that's the long run average. So at 13%, it's more than 2 times the long run average. Even the small and mid are over their long run average margins, which that's the thing that really gives me some pause for small and mid, because the margins there could compress back to long run averages, and then that's a slightly different argument. But the way that the way that I think about the margin, the stories for all of those, large cap growth is all-time high margins, all-time high PE on those margins, and all-time high earnings. And so every single lever has been pulled, is in the favorable position. And if any of those levers come back, then the market comes back from that level. For the others, it's a little bit more mixed because their earnings are definitely, like small earnings are trough earnings. Mid-cap earnings are flat. Margins are still extended. PEs are about average to below average. I think that over the last 25 years, historically, mid and small PEs have traded at a premium to large PEs, for the reason that mid and small tend to grow earnings faster. And that's true over the last, since 2000, that's still the case. The small cap earnings have grown faster than mid cap earnings have grown faster than large cap earnings. But we're in that same scenario that we were in the late 1990s, where the recent history, so since the pandemic, so since 2022, the large cap earnings have vaulted up. Small and mid's flat, small's down, and the PEs for small and mid are now at a big discount to large. That's ahistoric. And so if those go back to a premium, which I think it's all related, small, value, international, they're all trading at a discount because the S&P 500 has done so well for such an extended period of time, and you can buy it for basis points. If there's any mean reversion at all, then I think that those are the better places to be. What the catalyst is the billion-dollar question. And I don't know what it is, other than these things are always visible in hindsight, and they're never visible ahead of time. You just sort of have to invest a little bit on faith that mean reversion still works, even though I've been saying that for a long time, and that hasn't been the case. I still believe that is the case.
It's interesting too. I was thinking about AI and like how this impacts all of it. Like you could argue AI is obviously very good for the Mag 7 in terms of it just increases their advantage, but also like AI might be the first challenge to Google's search business, like the first significant challenge that's existed. So And also I think about AI as it relates to the other 490 companies or the small cap companies. Like, could that be something that finally vaults those companies up in terms of their ability to take advantage of this technology? Maybe it improves their businesses, and maybe everybody's just thinking about how it's going to improve the biggest businesses, but maybe it improves everybody's business. Like, I don't have any answers to it, but it just seems like AI is a game changer one way or the other. And I just don't know what it is yet.
I think it's transformative. I think it's like the internet was. It's completely transformative. And I think it's like the internet I think the analogy is quite deep. I think there's a lot of ways that they are similar. One is that there was a massive build out in fiber optic cable for the internet. It was like this mad dash to get fiber cable in the ground. And those companies took on debt to do it, and they were ultimately all donuts because they went through bankruptcy. But we did go on to use that cable, and it has a useful life of like 25 years, the cable at least. And I think it's probably even longer than that. It's just you can change the equipment on the ends of the cable and the cable still functions. You contrast that with the useful life for the chips that they're buying for AI. And I would say that the useful life for those chips, so I think that the big companies are writing them down in 5 years. The useful life might be even less than that. It might be 3 to 4 years because the technology's been improving so quickly. Faster and faster chips are required. So we're spending $500 billion this year on chips. A lot of that flows to NVIDIA and AMD and all those sort of companies. They all do very well. And that may just be a gusher for them forever. But on the other side, somehow those other companies like Meta and Google and the companies that buy those chips, they just expense them over a period of 5 to 7 years. They don't expense them in the current year. So you've got this weird thing where one group counts it as revenue and earnings, and the other group expenses it over a period of time. So it's like you get the benefit on one side and you don't have the cost recognized on the other side. But even now that is going to start flowing, the depreciation is going to start flowing through the financial statements in material amounts. So I think that'll change the complexion of those companies over the next few years. That they had previously been sort of CapEx light compounders, and now they're going to become quite CapEx heavy. And in fact, most of the CapEx spending that's being done in the US right now is on AI type technology, which seems to have a shorter useful life. So that's going to be interesting to see whether they can figure out how to generate enough earnings from that AI CapEx spend to justify that spend. And it seems to me that like maybe Microsoft has blinked a little bit with the number of data centers that it has. I think Meta has blinked a little bit with, they've had some cost cutting and they're losing some roles in their AI groups. So just be interesting to see how this plays out over the next few years, whether that headlong rush into AI is justified by the business results. I don't know if it is or not. It's just interesting to watch. And yeah, does that then go on? Is this a scenario in the late 1990s where like just having a .com and, made you a .com darling, and then that's just table stakes? There's no company in the world that doesn't have a .com now. Same thing with AI. Like it's at one point it's brand new technology, and pretty soon it's like commoditized and everybody has access to it and offers it, and it's table stakes.
Have you heard of the AI psychosis problem people are having, that they're getting so wrapped up in AI that they're kind of like losing their minds?
Do you think
It's actually it's going on?
I think that's marketing by AI companies, because I definitely don't have a good relationship with my AI. I would prefer that it hallucinated less. And I don't like the personality. I'm not a big fan. I find it like the thing where it gets it wrong, and then you point out that it's wrong, and it says, yes, you're exactly right, I was wrong about that. Like, well, fix it in the first instance. Like, why are you relying on me? I'm the fallible meat puppet. It's like trying to get you to give me the right answer.
Yeah, there's a lot of hallucinating going on in those models. You got to be careful. But are you I know you're working on a book. Obviously, you have investment processes you run. How are you finding you're using it either, in your work or in your daily life?
I've not found a good use case for it yet, honestly. I've used it for I give it stocks to analyze, and it just makes so many mistakes that it's not reliable. I've used it for some writing, but I hate the voice that it writes in. I find the voice, like you can tune the voice up a little bit. I say make it more casual, and then it becomes like it's too casual. And then I'll say, well, write shorter sentences. So then it hallucinates these conjunctions in the sentences that weren't there in the first instance, and correct something that wasn't there. It's imperfect. I can see that it could be a potentially very powerful tool, but I think it's getting closer and closer, but it's still not there for me. And I've finished the book, by the way. It's with a editor, like getting polished a little bit at the moment.
Great, congrats.
Yeah, thank you for congratulating me when it comes out.
YouTube thumbnails are one very, very strong use of AI. I've determined. It's like when you can take a ton of stuff and put it together, like in a way a human couldn't. So AI is not as good. Obviously, we spent a lot of time like figuring out like the titles of our episodes just because we've realized it makes a big difference. It's not as good as me as saying here should be the final one, but it is really good at taking the structures of what's worked in the past and figuring out the format of them and just giving me a ton of options. And then letting me figure out from those options, I can then talk back and forth with it and say, what about this? What about this? And like, I can make the decision. But like with all that data, like for me, myself to look at that and say like, what is the structure of this? And what are the winning formats and like that kind of stuff? I'm just not as good at that. It's very good at that. It's very good at taking a massive amount of stuff in and figuring stuff out. And then I use it as sort of a tool to help me get to the final solution. That's outside of investing, but that is one use I found that has worked pretty well.
I haven't used the graphics as much. I've used the writing version.
And it doesn't do the actual pictures, by the way. It just does the words to go on there. So really what we're working with is just like, how do you title this episode and like what words do you put on the thumbnail? And like looking at what's worked for us in the past and, trying not to be too over the top, trying to be fairly balanced, but figuring out what gets people to watch it. It's like, it's a whole thing that our viewers clearly don't want to go down the rabbit hole of. It has been an effective use of AI for me. That's one major one I've found so far.
I feel like it's my user error that is failing with it, but I can't quite get it there, and I'm interested to hear other use cases. So that's a good one. I'll try the thumbnails.
One thing I want to ask you is, so right now I think the U.S. equity market is maybe, and probably it's not a surprise by looking at the charts, but in terms of total world market cap, is maybe the highest it's ever been relative to the rest of the world. But what I'm interested in your perspective on is, and we were talking before we started, I mean, you went to Chile over the summer. I think you said you might have been to Tokyo earlier in the year, or Japan maybe. You're from Australia.
Yeah.
And, and I know you've been a lot of other places in the world. And I was recently, talking to some people in Europe, and like the whole month of August, everybody's gone on holiday. Like nobody seems to work over there. If they do, they're drinking wine at noon or something. So whatever. So, but I'm kind of like wondering, like, I haven't done nearly as much traveling as you have, but when you think about like if you think about like the top tech stocks in the world, besides TSM maybe, but they're all basically in the US. And just like American capitalism and our capital markets and innovation and, maybe it starts with venture capital and then all that. I'm just wondering, like, share some perspective on maybe, what makes us maybe unique relative to what you've seen around the world. Because I think you kind of bring some interesting perspective there.
No country in the world produces the consumer products and businesses like the US does. I think maybe that's not true. Maybe China is doing that now, but I think that's a relatively new phenomenon, like the last 10 or 20 years. America's just been doing it for so long. If you think about the outperformance of the US stock market over global stock markets, it's really those 10 companies that don't exist anywhere else in the world. Google, Microsoft, Amazon, to a lesser extent, I don't know if Tesla still counts in there, but Netflix, those sort of very big companies that just throw off huge amounts of cash flow.
Meta.
And they benefit, Meta, they benefit every additional customer that they have is like virtually costless to them, but they generate revenue and income from them. That's a uniquely American phenomenon. And that's the difference between the American stock markets and the markets in the rest of the world. it's so much harder to start a business anywhere else in the world. There's so much red tape in Europe. There's so much red tape in Asia. Trying to launch, set up a company, get a business license, file your taxes, all that sort of stuff. It's really, really hard, and it makes it so much easier to set up here, so much harder to set up there. And it's just shots on goal, I think, that give you the results. The more shots on goal you take. And there's a good, the US also has a great psychology about it. It's not fatal to your career and to your life to fail. Whereas in many countries, there's this sort of view of businessmen as being scammers, and a failure is just proof of your sort of fraudulent behavior. Whereas in the States, there are lots of businesses that, like Slack, doesn't make a great deal of sense to me as like a revenue generating idea, but that turned into a multi-billion-dollar business. There are lots of businesses that, if you had to articulate to someone before the fact why it was going to work, you really couldn't do it. I mean, Google was an example of that. Google was just a search engine. You would say, how would you monetize that? And not even they knew. And it was after they listed, or soon, or just beforehand, that they figured out the paid links in the search. And the guy who came up with that idea got like $1 billion bonus, or he's got $1 billion worth of Google stock or something like that. But it would be hard to articulate to someone what the business model was there. And clearly that's been that's perhaps the most successful business model that we've seen in the last quarter century. So I think Americans are much more willing to give you the benefit of the doubt on the business model if they can see that there's some consumer traction there. And that's created a giant VC industry and angel investors who are prepared to take a flyer on young people with energy and ideas. And that's created an incredible ecosystem of business. So that's unique to the States. The psychology of like investing and taking chances and succeeding is almost unique to the States. And that's been its great success. I do think that China is doing a lot of that now. One of the things that we were in Shanghai earlier this year, and I spent a week meeting with some of the best VCs in China, hard tech VCs, who are looking at their main areas are AI, robotics, and autonomous driving. They think that America leads in all of those. So the AI is, OpenAI has the best AI. Tesla has the best robotics. And, Tesla has the best autonomous driving. Why not Waymo? Because they say that the $20,000 in additional cameras that the Waymo vehicles require makes them uncompetitive with Tesla if they can figure out how to get their software to work without those cameras. And so in hard tech, the US is ahead. In consumer tech, the US may now be behind because China's become so good at producing technology cheaper. So, the second best AI in the world is DeepSeek, but DeepSeek was made at a fraction of the cost of OpenAI. So they say, I take that at face value at the moment, but it's possible that's not true, that there was some more investment in the back end, but they give that away for free. So there's lots of AI competing, and that's available for consumers at a much, much lower price. And probably in this race, it's going to be the ones who can do it cheaper are probably going to win that one. Autonomous driving, at least in EVs, maybe not autonomous driving, but in EVs, you can go to a Huawei showroom, you can walk into, see SUV, leather seats, TVs and everything throughout the whole thing. And it charges in 15 minutes and you can drive it away for $35,000. There's nothing like that in the States. And I think that they got to keep those Chinese EVs out of the States because Tesla's gone if they sell them here. In the robotics, there's a lot of money going into robotics, but I think that their ability to manufacture robotics more cheaply will put them ahead. So I think that there's a little inflection point. And that's one thing that I've noticed, that China particularly stood out. Shanghai, it's kind of stood, like Shanghai's there. New York, it's intensely busy. Everybody there's very ambitious. They're working, they call it 9-9-6. Everybody works 9 a.m. to 9 p.m., 6 days a week. And they're trying to get rich as fast as they can. So they pump up these consumer businesses, these consumer technology, online businesses. and they get hugely popular. Everybody uses them, and then they're supplanted by something else that comes in that's equally sort of new and shiny and impressive. And it's happened at a very fast rate. So I think that what is noticeable about the States is that everything is more expensive for consumers. But I noticed that too in Australia, and I noticed that too in Chile, and I noticed that in Tokyo. Like, Tokyo is a world-class city. They've got lots of Michelin star restaurants. It's beautiful, clean. People are polite. It's calm, peaceful. It feels good to walk around, and you go and buy a coffee and it's, $4. Where I live, coffees are $6 to $9. It's becoming, everything is expensive in the States. It's noticeably expensive, whereas the rest of the world, it's sort of cheaper and comparably good. That's my sort of, the thing that I've noticed is that the consumers, I think, are better in other countries at the moment.
How do you think about those U.S. advantages when you put it relative to the stock market? So obviously the U.S. stock market has done really well because of some of those advantages. It's easy to start a business, and it's probably why some of these great businesses have come up. But some people argue maybe those advantages are getting a little bit less. Some people argue maybe those advantages are justified in the valuations, or, we've even gone past that. Like, how do you think about the U.S. versus international when you take it to the stock market?
It's a hard question to answer, honestly, because in one sense, I feel like the sorting of the stock market isn't wrong. Like, I actually don't think that the S&P 10, that Magnificent Seven, I don't think that they're sort of egregiously expensive. Because if you look at the quality of those businesses, like they are throwing off a lot of free cash flow. A lot of that investment in AI is discretionary. They could run those businesses for cash and for buybacks if they wanted to. Like, they're investing for growth, and that's admirable and good, and they should be doing that. And that's why since 2002, they've leapt ahead. Like, that's really the only growth that's going on. There aren't very many companies. This is one of the screens that I like to run is who is investing growth capex that exceeds their, just do a simple, like, what's their depreciation and amortization look like in any given year? And what's their capex investment over and above that depreciation and amortization? There aren't many companies that sort of are investing at high levels. And the only ones that are doing it are the 10 that you know about, like Tesla and Meta and Google. They all sort of stand out as being investors. So I think that their valuations are, in some sense, like, they're justified. It's not unfair that they may be high, but they're not, they're not disconnected from reality.
They're not like the big companies of the dot-com boom, right? I mean, right. Cisco was like demonstrably more expensive than a lot of these companies, like at the peak of the dot-com boom.
I mean, Palantir might be different. Palantir at like 600 or 800 times earnings or whatever it's trading at. Palantir is a bit of a strange one. I couldn't really tell you what Palantir does, but if it's government contracts for AI type stuff, then the valuation is going to be all over the place and nobody knows. But you're right, like Meta and Google, they're all, like, arguably some of them are like reasonably undervalued. And there's some AI scare in Google that, for the reasons you articulated before, that the search is becoming that's one of the interesting statistics that I saw, that it used to be if you had a website that relied on traffic from Google, you got paid on about every second click that went to your site, because some of the clicks are Google indexing your site and some of the clicks are people going to your site and reading the page and then clicking on an ad on your page. And so for content creators, that was the way that they monetized. It was 1 in 2 originally. Sort of pre-AI, it had got down to 1 in 6. And now with AI, it's something like 1 in 250. And then from OpenAI's perspective, like, it's even less than that now, because they can serve 1,000, or they tend to serve 1,000 people from a single click. And so you don't ever see any of that revenue. And I know that the way that I interact with Google now, I often just use their sort of AI summary at the top of the page without needing to click on any of the links. So that's definitely going to change the complexion of the content creating economy and so on. That's a big change, and I don't really know what the impact of that's going to be. But you're right that the overvaluation is sort of, it's visible in the data, but when I drill down to the individual names, it's not entirely visible to me. So I think that probably those Mag 10 are reasonable bets for the extended future. But I think that the better returns are going to be in those things that recover from this sort of small earnings recession we've been in since 22, which is sort of hidden by the fact that the top 10 are so big and deploying so much capital and growing at such high rates, they sort of paper over what's happening underneath to the rest of the market.
I'm trying to think, let me pivot here to, I want to talk about maybe the Fed for a minute, just because obviously I think Powell's going to be giving a speech from Jackson Hole. They're in the news a lot recently with Trump and his pressure on Powell with rates, but I'm trying to think, has there ever been, I'm sure there has, I can't think of any off the top of my head, where the Fed would be easing, not during, I mean, there may be weakness in different parts of the economy, or maybe there's strength in certain parts and everything else is just sort of stagnant. But, I mean, there's a likelihood that they'll probably, move lower rates in September. And I'm wondering if it's just interesting that maybe that acts as a catalyst for the market, or maybe not. I don't know. But so that's the one question. And the other sort of thing, and this kind of goes back to the U.S. economy a little bit, one of the headwinds that I personally see or worry about is like just household formation and like affordability in this country. Because, we know that the Fed, those rates, aren't going to necessarily impact the long-term rates. And it's just like the level of home prices in this country and, first-time home buyers' ability to enter the market and just household formation. I mean, that was such a tailwind for this country for, the last 50 years up until COVID recently. And now you're kind of, that's a big issue that I think is going to come sort of full circle and could be a headwind. So two different things there, just, but both kind of have to do with rates and the Fed. And
yeah, the home building thing, home prices are a problem. 80% of Americans can't afford the median home. So that's a problem. And then there's a lot of economic flow on from you buy a house, you got to buy appliances. There's a whole lot of stuff that goes into a new house. And then you have kids and the kids go to school, and there's a lot of consumption that comes out of that. We've seen it at our local elementary school. My kids went this morning for the first time this summer, after summer. And they've lost some teachers because they don't have enough kids at the school, because we're now seeing the impact of because the 5-year-olds who would have 2020, like there just aren't as many around. And so there's not as many coming in the front door, which means that everything else has to shuffle along, which is a little bit concerning. And part of that is houses are egregiously expensive relative to what people earn. So they can't afford a house, which makes them hopeless, makes them feel hopeless, and makes them look to more extreme political ideologies. So there's a lot of negative effects from that. I don't know that dropping interest rates affects that much, because if you look at Nick Gurley he runs this reventure app where he looks at house price, looks at this sort of data, and he said that cutting rates like 1.5% isn't enough because the house price is so expensive. The house price have got to come down 15% nationally on the back of that, that's a pretty big haircut. I think that's probably ultimately what happens. It has to be prices coming down, because I don't think that rates are going to help much, because also you got to come up with a deposit. Like the deposit's the bigger headache than the income is. The Fed has typically lowered rates when there's weakness in the economy, rather than, markets at all-time highs, house prices are at all-time highs. There's a lot of earnings growth. It's hard to justify cutting rates at this level. The only reason that I can see would be that they've tracked the 2-year pretty closely. And when they set the federal funds rate under the 2-year, you get this explosive speculation. When they set the federal funds rate at a premium to the 2-year, it sort of dampens everything a little bit. And we've been at this little premium here, but that we've clearly had some explosive speculation in shitcoins and, crypto generally. And a lot of companies that just, pre-earnings, as you might say, being kind to them, maybe they never become earners. the 2-year is currently at, I think the federal funds rate is at 4.25%, and the 2-year is sitting at 3.75%. So there's about 50 basis points that they could cut to get down to the 2-year. And I think that the most likely cut is 25 basis points in September. I don't know that 25 basis points really makes much difference one way or the other. Typically, they've only cut heavily when, they cut when the stock market falls over. So if we get a big stock market crash, then they might start cutting, but it indicates weakness in the economy. I don't really see that weakness at the moment. I mean, the stock market is as expensive relative to energy as an input into the economy. It's only happened in 2020 and 2000 that it's been this sort of stretch, which means that energy is one of the things that spikes economic cycles because the energy gets too expensive, oil gets too expensive, everything costs too much, and that spikes the economy. And then they cut when the economy is sort of in the downswing. It looks pretty strong to me at the moment. Maybe the tariffs are a sort of exogenous shock that is something like COVID in 2020, where it's not something internal to the economy. It's like something imposed on the economy. That could be pretty serious. I've started seeing emails come through from folks who I buy from on a regular basis saying, if you want to, skip ahead of the tariffs, you have to buy now. And even if we have to pay the tariffs, and we'll eat the tariff, but as long as you buy now. And because I think the tariffs are now starting to roll into some things, and the numbers, it's like 50% on dairy from some places. Like I don't know where they found these numbers. They're not serious numbers. I don't know what the impact of all of that's going to be. Maybe the president has decided that industry and consumers are going to pay to sort of reindustrialize America, and for strategic geopolitical reasons, that's a good move, and it's going to hurt the economy and the stock market. But that's the cost that you pay to become competitive with China on a manufacturing basis. I don't know if I want to be long the index if that happens, but maybe the AI names aren't impacted by that at all, and so it doesn't matter. And it's just everything that's been struggling underneath that continues to struggle. Somehow we got to get house prices down. That just sort of seems to happen with the effluxion of time, as they say. There's historical precedent of rates going from very low to, we're just at a long run average here. It's not like it's that high. And it seemed to freeze the housing market for about 4 years. And then housing prices, as people have to move for work or for school or for whatever reason that people have to move, downsizing or whatever reason, the housing market does come back into equilibrium. It's now 4 years since the peak in house prices. They peaked in 22. Nationally, they've been rolling over since then. Median house prices have been rolling over. Maybe we see 26 would be 4 years. Maybe we sort of see some action over the next year or so, and that brings houses back down into line, and that starts the process again. I mean, that would be a good outcome. I think, it's a very, very hard picture to tease out because COVID really, every single commodity that I follow had this massive run up and then a massive crash back down. And that flows through the earnings so you get lumber spiked in 2020. That crashed all of the housing stocks. And then they all recovered and became fabulously profitable when lumber came back down. And that, you can pick any industry where they've got big commodity input. And the same thing happened in industry. They had this shortage followed by a surplus where they made a lot of money. Kind of in that period now where it's hard to look back and see what the baseline is because you've got to pass out a glut and then a surplus the surplus and then a shortage or whatever it is. It's a strange time in the market. It's very hard to tease out from these businesses what their normalized earnings are. You just got to take the average, I guess, and then hope that's accurate. But then on top of that, the margins are stretched. So I don't know. Very, very complicated picture. Probably justifies lower equity prices, and that's what we're seeing across the board, except in the S&P 10.
Your reference to COVID brought me back to, remember you invited Jack and I down to the New York Stock Exchange for your...
Was that during COVID?
Well, I think it was after, and they made me go get the test, the COVID test. And then I went to get it, and then I actually didn't need it. And it was just crazy. I don't know. It's like I'm running across the CVS and getting the test, and they're testing that I'm negative or whatever. I was like, this is crazy.
That's
But
crazy
anyway,
times.
crazy times.
Thank God that's over.
Mm-hmm.
On the Fed stuff, like, what do you think about the idea that, like, as value investors, should we care about that? Like, there's some evidence to suggest, like, some people think, oh, obviously high rates, great for value, low rates, great for growth. But then when you look at the actual data, it's sort of ambiguous. And some people say maybe inflation matters more than rates. Is there anything in there that would give, like, value investors hope depending on what's going on with inflation or rates? Or do you think it's pretty much irrelevant?
I would say that it's so complicated that you almost, like, it's like this, Buffett says, ignore the macro, not because it doesn't impact anything, but because it's not predictable. Like, you just don't know which way it's going to go. Inflation has been a help to value stocks in the past, but like on a purchasing power parity basis, has it been a help? I don't know. I don't think so. It's probably a wash, and maybe it's a slight negative. Inflation hurts every industry. And inflation has certainly been here as a result of all the COVID stimmy that just went on for way too long. And now the tariffs on the other side, I don't know what the impact of that's going to be. I know that the Fed likes to track the equity risk premium, which is the earnings of the S&P 500 over the prevailing Fed funds rate. But John Hussman has some research that says that the equity risk premium is sort of irrelevant in predicting where stock prices are going to go. The thing that predicts where stock prices is going to go is just the absolute earnings yield. So you just ignore the interest rate as a portion of that. Having said that, clearly small and micro and mid cap are much more sensitive to the economic cycle and to interest rates than large caps are. And you can see that in any number of ways. You can look at I saw a chart that showed the maturities for small and micro versus the maturities for large caps. Large caps pay a lower interest rate and their debt is termed out much further out. So they're not at all impacted by short-term changes in the rates. They encounter those problems 4 or 5 years down the track. Whereas small and micro, they're all like, whatever change in the interest rates, it impacts them almost immediately because their debt's just not termed out as well. And they're economically sensitive because they've got one line of business, less experienced management, less in the way of resources. So I think that that's certainly why you see, that's why we are where we are, I think. I don't think it's that, I don't think it's that hard to figure out why small and micro and mid cap have struggled, and it's because their earnings are down or flat and their multiples have followed suit, because why wouldn't they? Of course they'd be. You look at earnings down, you give that thing a lower multiple, you sell out of it. Large earnings are up, gets a higher multiple, you want to buy into it, it makes complete sense. You have to be a real contrarian to look at the earnings down and the low multiple and say, that's for me. I'm going to hold that because that's going to turn around and that multiple is going to expand. I actually think that that's what's going to happen. But I can understand why, you might not want to do that, because it certainly looks like they're weak. Looks like they're subject to higher rates. They're certainly economically sensitive. They're all going to get whacked with the tariffs. It's like a perfect storm for the small and micro and mid cap.
Hopefully it's all discounted in.
But that's what I think too. I actually think it is discounted in. I think that the success of large is also already in the stock price. It's not, in 2015, small and micro was trading at the same PE multiple as large. Small and micro value was the same PE multiple as large growth. And that's wrong. Large growth should be a premium. It's just how much of a premium. And I think the premium is too high now. And the returns are going to be better in small and micro value. But it's hard to buy. And that's why the opportunity exists.
So, Toby, we like to ask our standard closing question. As you know, you've answered. I'm surprised you haven't answered this, but I don't think you have, because it's in my notes here. So the new closing question that we like to ask our guests is, what's the one thing you believe about investing that the majority of your peers would disagree with you with?
I think that, I could say something like, I think small value is going to recover and do well. And clearly people don't feel that way because that's why it's discounted and that's where it is. The one thing that I really think is that the value index, I don't know if you guys have seen those charts of like the S&P 500 growth index versus the S&P 500 value index, but the jaws are yawningly wide. Like they've never been as wide as this, including in 2000. Like 2000 is this little bump now relative to the width of these jaws. And people say, well, there's a composition problem with that index. It's a shitty index, the value index. And those jaws will never close because the composition of those two indexes is so bad. I think that those jaws will close. And at some point, value will trade at a premium to growth, which will make no sense. I agree that right now I'm telling you that it makes no sense, but I still think it's going to happen because it'll turn and then all of the speculation will move into value, which it did from 2000 to 2007. And that's why it got pushed beyond all reason. And it'll get pushed beyond all reason now, even though the index is not as good. The index is shitty. Because that's the nature of mean reversion. It's sort of a little bit of a mystery. That's the Graham's famous comment in front of a commission in the 50s after the collapse of the stock market. I said, like, how does mean reversion come about? You advertise, or what? How does that work? And he said, it's a mystery. It's a mystery to me. It's a mystery to everybody else. I think we'll have this mysterious run back to value, and then it becomes self-reinforcing once it gets a little bit of steam. Then everybody says, well, it makes total sense. They've got the better fundamentals, and the fundamentals are growing at a better rate. Look, they're undervalued, so it makes sense that you would get these returns here. And everybody will forget that they said that the jaws would never close, but I think the jaws will close and the jaws will overlap. And I don't think anybody else thinks that.
Nice. Thank you very much, Toby. Let's make sure when the book's out, we have you back to talk about that and a bunch of other stuff. So we always appreciate it, man. Thank you.
Likewise. Thank you very much for having me on, gents. I'm very grateful for these opportunities. So thank you, Jack, Justin. Always good seeing you guys.
Thanks, Toby.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.